It's something common that I've been hearing a lot about is like people wanting to buy in their local vicinity. Because at the end of the day, an investment property is for financial results. That's all it's for. That's the whole purpose. And I gave the analogy that it's like trying to choose stocks based on if the office is close by.
We are back in your life, and today we've got Lighthouse's property director, Adam Farrell, with us to tell us all about investment property, what you need to know, 5 great steps. Adam, tell us, what is step number 1 of our journey to investment property?
So step number 1, it's all about starting with strategy. I think I mentioned this in the last podcast, which was quite a while ago now, that people overcomplicate things. And with property, having 40,000 listings on Trade Me is a pretty daunting place to start sometimes. So obviously with what we do at Lighthouse Property, we've helped clients go through a process of elimination and narrow their scope of what their options are out of those 41,000 listings, so that it becomes a little bit easier to highlight what's going to be the right investment for them.
It is really important to start with, what is the goal? Because we get a lot of people that come to us and just give me the house. And I'm like, yeah, that's fine. But like, what do you actually want out of this house, Yeah,
that's a really interesting point, because for a lot of the newer investors, which is kind of my clientele typically, the buying process that they followed previously is just all about their own personal home.
Yeah.
It's really emotional, very different train of thought.
Marble bench tops, nice good indoor-outdoor flow.
Yeah, I think you were mentioning last time a white picket fence and, some freshly baked cookies on the windowsill you were talking about.
It ain't got them, I ain't buying.
So that's a very different buying process. And so as you say, knowing your why is the most essential thing starting off with, because there's a few different avenues or results you can achieve from property investment. It's either capital gains, cash flow, or you can take the approach of like capital improvements with renovations, developments, etc. There's a little more complicated. But at the end of the day, you do need to start by understanding the difference in what results you can achieve. There's 2 different buyers. Like I'm sure you have plenty of clients who are closer to retirement who come in saying, hey, I want to buy this asset because it's got great capital growth potential, but at the moment they're in a cash flow deficit. And so they need to change their approach there. And vice versa. Some people come in going, hey, this has great rental yields, but it's a, unit title on the viaduct or something like that. It has 0 growth potential and they're still 20 years out from retirement. So understanding what your goal is and why is a really easy way to narrow down the scope of what property categories to focus on.
Yeah, I try and say for clients that are like buying a new build, for example, or a townhouse, just going like, look, just when you go and see it, this is not about where you want to live or what you want to do. This is really all based off the numbers. And if you focus on the numbers first, you'll be fine. But some people just get a little bit emotional during it, I think.
Yeah, super common. And I was on a call with a client a couple of days ago, and it's something common that I've been hearing a lot about is like people wanting to buy in their local vicinity, regardless of where they are, whether it's in a major city or a region. And the analogy I gave them was it's kind of like, because at the end of the day, an investment property is for financial results. That's all it's for. That's the whole purpose. And I gave the analogy that it's like trying to choose stocks based on if the office is close by.
I like that.
Which is ridiculous, right? You would never apply that train
from
of
you,
thought.
Adam. That's a good one.
Thank you. Came up with it myself.
Yeah. My father-in-law, He had an investment property, but now he doesn't rent it out anymore because it stressed him out too much with the tenants. But he would always drive to go mow the lawns himself. And he's in Invercargill, was going to go then buy an investment property in TR now. And I was like, you can't buy it. It's too far to drive to mow the lawns. But the whole being like I do hear from those in terms of the proximity going like, oh, I can go like mow the lawns and drive past the property. But the reality is you're going to do it once and then you're never going to do it again.
The next point that we're talking about is understanding like affordability and working within your means. I think you can probably talk a lot to the affordability side, Mike, but just really quickly, I wanted to make the point with considering your strategy is being realistic about what resources you actually have, because obviously price range and cash flow is a really important one. But
absolutely,
beyond that is also time and skills, right? If you want to do anything that isn't passive, like tangible renovations, time and skills is a super important consideration. A lot of people think they can get into the flipping property side of things, and everyone thinks they can be a handyman sometimes. Just being
my
realistic.
advice on that is don't flip properties. Just don't. You can literally make tens of dollars flipping properties and you can literally lose hundreds of thousands of dollars. I'm like, at this point, I'm like, have you thought about the casino? I'm literally like, have you thought about just going to the cast and seeing if you can win it all back? Because like you've got about as much chance of like red or black as you do of actually making any money off a flip.
And it's a job as well.
Yeah,
I mean,
I know.
sometimes like I'll be doing a financial plan with a client and they'll both be working like 50, 60 hours a week and have 2 kids under 3 and go, oh yeah, we're thinking about renovating a property. And I'm like, when are you going to do this?
And like for everyone who's looking at me going, but like I flip properties and I've made heaps of money, or all the coaches out there, like, yes, you're a professional property flipper. If you're not a professional property flipper, very unlikely you're going to make money.
Yeah, absolutely. And that's why it's so important to be realistic, because you'll hear all these individuals promoting their results of what they've
Lies.
done. Maybe it has some truth behind it sometimes, but nonetheless, it's really just about making sure you're confident and capable of that as well. And if you're not, then just cancel it out. Don't get distracted by the noise over there.
Yeah.
So how do we deal with like, I think a bit of chicken and the egg with, do I find the property first or do I get the lending approval first?
I think it's probably step 2, understand what you can afford, right? So go have a chat to a mortgage broker, see what they can do, what you can, like realistic about your resources, your time and everything. Because we talk through that with customers as well, around like how much time resource do you have for this? But basically, what can you afford from a lending perspective, a borrowing perspective, a purchasing power? You know, that is really key. Otherwise, you end up wasting a ton of time on this and then you get overwhelmed.
Yep. What do you think about giving the audience like some rule of thumbs of figuring out what they might be able to afford?
Yeah. I would say speak to a mortgage broker. Yeah.
Okay.
My great rule of thumb is speak to a mortgage broker.
Yeah, I absolutely agree.
The issue with rules of thumb is that for some people, they're not going to be accurate and they'll be over, thinking they can borrow too much. But for most people, we've got to be conservative with the rule of thumb, right? Is actually, you're probably going to be undershooting. And like what people are generally asking me with this is debt to income ratio stuff, right? Do I 5 times my income? Do I 6 times it? Do I 7 times it? All of that is fine. But actually like just in the time it takes you to sit down and calculate that and get it right, if you chat to a mortgage broker, they can just do it quicker.
Step 3, choosing the right investment property.
Okay, so we've got a couple of avenues that we typically focus on with everyday investors. The first one that we consider is new build versus existing, both of which have pros and cons. New build is really easy, efficient, low maintenance because it comes with a 12-month defect warranty, 10-year structural warranty. You don't want to lean on those. Hopefully you just buy a good property that never needs any sort of rectification. But they're low maintenance. They typically appeal more to tenants, so it's easier to rent out because it's healthy home standard compliant most of the time. And then usually, if you buy the right asset, it's going to be close to infrastructure, close to working hubs, and the rental yield is going to be pretty strong. So really easy investment. Existing homes, typically with clients, if they are considering an existing home, it's because they want something that's standalone or something a little bit older that they can do some small renos to later if they want. The pro with the existing stuff is, one, you can have some tangible renovations involved. So for capital improvement, you can gain some equity if you do that well. 2, with something that's standalone on more land, there's typically, data's really limited on this. We're trying to find some more on it, but it looks like the growth rate is slightly faster, typically on a standalone home, just because there's more land.
Yeah, it makes sense.
But in that case, the compromise is that it's almost always going to be a high purchase price, and yield is not going to be as strong because of that.
Yeah, and when Adam says yield, we're really talking about how much money you need to top up this property by. And I see like a new build, how much you need to top it up by per month versus a standalone house, because it's a bigger parcel of land and the rent doesn't stack up as well. You're going to have to throw more cash at it in more situations. I think there's also a bit more risk. If you buy a new build and you're working with somebody, chances are you're probably going to get something that's pretty good. An existing property is a very vast array of options. Sometimes the amount of time I talk to somebody for the first time and they default to apartment, I'm not sure where the logic is, but so many people go, oh, I just thought I'd buy an apartment or something like that. I'm not sure where that, maybe they think it's smaller, so it's like less of a commitment.
Apartments, I mean, first of all, they don't typically have much strong growth. On average, is significantly lower than a townhouse or a freestanding home, for pretty obvious reason. I mean, first of all, you don't typically own any land in those sort of scenarios. It's often a lot more headache as far as body corporate involvement and dealing with all of the residents in the building, or the body corp fees themselves, maintenance, all that sort of stuff.
The maintenance, I think, is a really good point, because if you've got this big building, right, there's just so much risk. Opposed to if you've got a property, it's much easier to go through with a building inspection and work out what's going on.
Yeah, absolutely. I mean, there's plenty of examples where body corporate fees just go through the roof, and that's largely why body corps in and of themselves have a really negative reputation.
Yeah. We had a customer in Wellington who bought an apartment. The insurance policy expired. They tried to get another one, couldn't get any in New Zealand, couldn't get any in Australasia, couldn't get any in the UK. Had to get an insurance policy out of Brussels for the building, and she ended up having an additional $1,300 a month levy on top of her body corp just to pay the insurance.
That is wild.
Yeah, couldn't sell it because no one wants to pay $1,300 plus a body corp plus the actual price of the property.
And then also the general principle with apartments is that typically there's much more supply comparative to demand. If you look at like a small development, which we focus on, where there's a limited amount of dwellings so that you're not competing with so many similar rentals or houses for sale when you go to sell. Apartment blocks usually, sometimes up to 100, 200 examples of pretty similar specification.
Yeah.
So when it comes to supply and demand and that factor of capital growth, it's obviously not in your favor in that sense.
Awesome. Okay, well, Adam, step 4 is knowing all about your numbers, and we want to talk about that after this break.
At Lighthouse Property, we help you find the right new build to match your strategy. No guesswork, we make it nice and easy. Book a chat with our team in the show notes below and start your property journey today. Now, back to the episode.
So Adam, before we get into the numbers, I just want to hear a little bit on your thoughts of buying in a major city centre versus the regions.
Yeah, sure. Look, ultimately it does relate heavily to the numbers because it's largely just a yield versus growth play. Typically for newer investors who have a pretty small portfolio, I do encourage them to focus on the city centres because that's where we get the majority of net migration, at least consistently. And that's a huge factor when it comes to supply and demand and overall capital gains. And most of my clients are, 10 to 20 years from retirement, so capital gains is more of a focus. Makes it a bit easier as well as far as decision-making goes. It's almost like a safer bet to put your money into these bigger central regions because there's going to be demand, especially if you're within 20 to 30 minutes off peak of the CBD. There's always going to be tenants and people wanting to live in that general vicinity. And then when it comes to regions, because land is so cheap, it's very much a yield play. Quite often you can get much stronger yields out there. Depending on the client, sometimes it can just be a little more higher risk for potentially higher reward if capital growth is still important to them, purely because net migration is not as consistent or stable out in those smaller regions. And so the timing of which capital growth will kick in because of more demand is a little less, there's a little less certainty around the consistency in that.
Yeah, I know what you think, Mike. I just think for people who are looking at their first investment property, just trying to simplify it as much as possible. And you can get complicated later, but just for the first one, just keep it nice and easy.
Yeah, I think the simplicity factor is huge. Again, there's 1,000 different ways you can carve up an investment property. If you don't have the experience, the balance sheet, the risk appetite for a lot of them, it just ends up being a disaster. So starting simple is a massive thing.
Cool. So Adam, tell us, how do we learn about our numbers?
Obviously one of the big ones that Mike alluded to is just chatting with your mortgage broker first. A big focus for us is making sure that properties have sufficient yield. In Auckland, I think the average is somewhere in the 3% for rental yields. And on an average, 800K property, that's going to be a pretty substantial top up that you're contributing weekly as far as your cash flow goes. So making sure the yield is pretty decent. In Auckland with the new build space, I'm always trying to get around that 5% gross yield mark, which is pretty strong. It's well above averages. And if we get there, the cash flows are pretty sustainable for most of our clients. And then with growth data, we just work on the basis or the assumption. You can speak to this a little bit more than I can about an assumption it's going to be 5% growth per annum. Where does that data come from?
Historically, it's about 6.5.
Yeah.
And a lot of people go, that's not sustainable going forward. I tend to go, okay, well, let's pull that back and go 5%. Seems like quite a logical place for me to sit. And it allows me to use it outside of just Auckland as well. Yeah.
I think it's really important that whenever you're considering your property investment decision, we've got a cash flow calculator online that you can look at your cash flows and make sure you can actually afford it. But I guess something that's really interesting with newer buyers is sometimes they can come in with the assumption that it's going to be cash flow positive and that's why you invest in property.
I'd like one of those, please.
Yeah, we all would. It makes it really easy. But when you're running some general numbers, if you're topping up something by $200 a week or 10 grand a year, if it's worth 700K, which is a pretty typical price range for us, if that's going up at 5% per annum, you're gaining 35 grand in equity in the first year and then it compounds over time. And obviously we're putting 10K in, aside from the deposit and stuff that you might have put in, 10K in for a 35K return is a pretty substantial result.
Yeah. 300% return on money. I'll take that every day of the week. Michael, what do you think about I've seen clients buy at the peak in places like Humu, Silverdale, and those properties now, because the market's changed, the rents have really struggled.
Yeah. Well, there's two different questions there. There's buying in locations that are further out of the city, and then there's buying at the peak of the market, right? And that, unfortunately, is just a combination of both of those things. And that was more of a, what could I get my hands on at that time? But like, look, buying further out of the city and typically a larger family size home, again, like to Adam's point before, the further out you go, generally speaking, the worse it's going to perform because it's further away from the city centre.
Yeah.
So I'm not a huge fan of it. Also, that style of home, like the large family home, probably just going to get damaged a bit more. Like kids, pets, and like neither kids nor pets are bad. They don't break things on purpose. They just damage stuff, right? And yeah, it's just going to be a bit more of an issue.
Beef Wellington just bumps around the house a bit.
No, he just punches. He swipes everything. Yeah, puts a paw through the wall on a daily basis.
Adam, I think the family home comment's a really good one because coming back to that idea of people want what? People are thinking, oh, this would be good as a long-term investment, will go up more in value. But sometimes those 3 and 4 bedroom homes, those cash flows just look horrendous.
Yeah, and I think that's where the Auckland average yield comes from is around that 3% mark with these bigger homes. Particularly if they're in nicer locations, you're looking at well over $1 million for a 3-bedroom, anywhere within 20 minutes of the CBD.
Yeah,
and typically, 3% yields means you're probably topping up by $500, $600, $700 a week.
Especially on the you've got to pay a minimum amount to rent a house anywhere in the country. Right? That's kind of built into the price. Then on top of that, you have kind of the premium for the bedrooms, and the more bedrooms you add, the less premium you really get. So you're kind of like, once you start to get into those like larger or more bedroom homes, the family homes, that premium is just not really as much. So the yield just doesn't work.
Yeah, I understand.
The next one's probably around interest rates I'd like to talk about. So a lot of people got in a lot of trouble when they bought houses in 2021 and planned their lives off 2% interest rates. Then they got into a world of trouble. When people are running their numbers, what interest rate should they be doing their projections on to make sure they're going to be okay?
I would say at the upper limit, about 7.5% to 8%. If things go above 7.5% to 8%, that's a wild ride. I don't think we'll get above that, especially with the debt to income ratios we have at the moment. So if you can do it on 7.5%, that's okay.
And what do we think about interest only versus principal and interest?
It depends on the situation. If you got owner-occupied debt, probably focus on clearing that first because you usually get a better tax treatment out of that investment property debt.
With your comment around operating on a 7.5% assumption, would you then suggest that
that's the upper limit?
Upper limit to make sure you're safe and solid.
Yeah.
Would you then suggest that if you get any kind of approval because they're testing you on test rates, it's a really good indication that you genuinely can afford
They're
it?
testing up around there. Yeah. So the test rates do track with the floating interest rate. So they will come down a bit, but they're not going to get super low. Again, I think the banks learned their lesson when interest rates were around like 1% and they were testing at like 3%. We should probably have a floor on these test rates.
That's what I was going to ask you was how low did test rates get? Did they really get to 3 or 4%
No,
test
like
rate?
4.5% or something.
Jeez, that's pretty wild when you think about it.
Yeah, but it's again like test rates hadn't been around for ages. So yeah, I think it was the first time. And also like it's the middle of COVID, man, give everyone a break.
So in a way, people should take a lot of confidence if they get an approval because it means that the bank is certain that they can afford it.
Yeah.
Okay, Adam, you've got one more tip for us. Hit us.
Cool. All right. Yeah. Get the right advice. We're at the end. So we've gone through the first 4 steps. We know why we're doing it. We know what sort of property we want. We found the sort of general market we're looking at. Hopefully between step 4 and 5, you've found a property that stands out to you, that you're confident going and putting under contract, which is something we can discuss in more detail in another episode, the process of negotiation and contracts. But yeah, getting the right advice is super, super important. You would have already engaged with a mortgage broker, at least I hope, at this point in time. If anyone made the mistake of not doing that, how much time minimum do you think you need to be able to help someone buy a home?
24 hours.
Nah, that's probably a bit tight. I'd say 48. Nah, you probably like a pre-approval is probably 2 weeks. An approval, you don't want less than 2 weeks. That's tight.
Yeah, absolutely. Hopefully with this property you've got under contract, quite often you'll see a due diligence clause put in there, which will buy you enough time to get your finance approved and in place. With legal, it's really important that you use a property specialist lawyer. There's been some really interesting client case stories where they haven't done so. There was one recently where a client used their lawyer from a small region they're from that they've been using for 40 years. who, to be honest with you, I don't think they've ever dealt with a new build property before.
Yeah. A lot of farms. Done a lot of farms.
A lot of farms, yeah. And so I had to get on the phone with this lawyer, and I mean, they were making some ridiculous suggestions as far as what they wanted to do with the contract. They were talking about a 7-month due diligence clause because they weren't comfortable with their client going unconditional before the property's built. And so anyway, long story short,
You're
because
like, the house isn't built yet. It's called off plans.
40 years in the industry. Did you get them on the phone, or did you have to fax or page?
I managed to get them on the phone.
Morse code.
But yeah, point being is that, long story short, because this client used a lawyer that wasn't as familiar with the process, especially with the new build market, this client was very frightened by the advice and the uncertainty that the lawyer had, and ended up completely pulling out of buying a property at all because of that experience. So,
and the cost. Because they just keep reviewing things. They push back on, like, the frame's up for their house. And they're like, I want to guarantee the minimum size of their house. I'm like, the frame is up.
Yeah.
How are we going to shrink the house?
It's such an The cost thing around lawyers is interesting because sometimes people sort of refrain from going the specialist route, i.e. a property specialist, because they might be charging an extra $500 to $1,000. But as you say, because they're familiar, they're really efficient. So typically take less time, charge you less. But in the grand scheme of things, if we're talking about a $3,000 fee for a $700,000-$800,000 investment, make sure you do it well. It's a really easily justifiable advice fee.
And we're talking about getting that professional support. The accountant, very important as well.
Yeah, it's easily overlooked because obviously accounting isn't always sexy, even though we promote the hell out of it over here. It's really important from a professionalism and future-proofing, and even from a protection standpoint, depending on the client. Sometimes it's okay to just buy in your personal name, and it makes sense, and that's what the accountants recommend. But other times there's other considerations like look through companies and trusts to get involved if you do need some more asset protection involved there.
Okay, well, there are your 5 steps for a beginner's guide in investment property. Adam, thank you very much for your time today.
Thank you. Good to be here.
Much love to Lighthouse Financial for sponsoring this episode. Please subscribe to our YouTube channel, give us a review, give us a like, and we'll catch you next time.
Cheers.